Hello traders, let us take a perspective on pivot points as a critical technical analysis tool that is often used in Forex trading. As you can see on the chart, we have some lines that are marked R1, P, S1, S2, and S3. These lines denote the pivot point, resistance, and support levels for the current market. Pivot points are technical indicators that are often used by traders to identify potential support and resistance prices in financial markets. They are usually calculated based on previous day's high, low, and the closing prices. We see that traders use pivot points and the support and resistance levels they provide to determine their entry, exit, and stop loss prices for the trends that they intend to take on any given trading day. We have to note that pivot points were developed by floor traders in equity and commodity markets. Typically, at the start of each trading day, they would use the previous day's high, low, and closing prices to calculate the pivot for a given trading day. So, how are pivot points calculated? As you can see, or rather, before we look at how they are calculated, we have to mention that the main techniques that most traders employ to calculate the pivot points is the 5-point system. This system usually factors in the previous day's high, low, and the close, as well as the support and resistance levels. And now, as we have outlined on the chart, you can see that pivot point is given by the previous day's high plus the previous day's low plus the previous day's close, and then you divide that by 3 to get the present days or the pivot point to use on the present when trading on the present day. At the same time, as you look, we can see that the first support is given by multiplying the pivot point by 2 and then subtracting the previous high from the product you get from the multiplication of the pivot point by 2. Then at the same time, you can also see that the first resistance is gotten by multiplying the pivot point by 2, and then whatever product you get, you subtract the previous low from that, and so it is, and so forth and so on. So we see that when calculating the pivot point, the point acts as a primary support or resistance level, or rather, the pivot point usually acts as the first support or resistance level. Traders should take note that high volume trading usually occurs when the price is near or at the pivot point. As a Forex trader, you can take advantage by engaging some of the following trading strategies that are often used by traders in Forex markets or in relation to pivot point. The first is pivot point bounce. What we see is if the price action hesitates or bounces back before reaching the pivot level, you should enter the trade in the direction of the bounce. What we mean here is that if the price was on a downward trend and then it reached the pivot, or it reached near the pivot point and then bounced upwards, then you should take a long trade. Conversely, if the price was going up, then it reached the pivot point and bounced downwards, then you should take a short trend. The other strategy is pivot point breakout. When the price action breaks through the pivot line, such as crossing from below 8 to above 8, the trend should continue in the direction of the breakout. If the break is bearish, the trade you should take should be a short trade, or you should take a sell trade. While if the trade is for bullish breakout, then when you are trading, you should take a buy trade or a long position. Okay, so another thing is what they mention is that a good place to implement a stop loss order is slightly to the other side of the pivot line. For example, if you are taking a long position based on the price closing above the pivot line, then a sell stop would be placed a bit below the pivot line. That is, if the market has broken above the pivot line, then, and the market, in which case the market should be trending upwards, then if you are going to place your stop loss order, then the stop loss order should be somewhere slightly below the pivot line, so that if the market aggressively reverses its direction to a downward from your position, that is, goes against your position, then when it breaks past the pivot line, then you will not lose, since the market will stop you out with a small loss, having hit your stop loss order. Now, the other thing that we would like to mention is that there are a number of reasons why traders like engaging in analyzing the market using the pivot points, or even trading using the pivot point. Some of the reasons that you'll see is that it is an easier to use analysis. Number two, you can use the trade on short time frames, or you can use the tool on short time trading frames or rather, and then finally it is highly accurate, or there is some high accuracy that is related with pivot points. You see, it's worth noting that the pivot point is considered as one of the most accurate indicators in the market, and as such, majority of the traders in forex markets usually use pivot points to gauge or to map their trading, or to map their entries, their exit, and their stop loss and take profit levels. Finally, we have seen that the pivot points are used in determining market trends, and basically to determine the enter and exit levels. Finally, we would like to conclude by mentioning that pivot points are a versatile tool used by traders to identify potential levels of support and resistance, which enables them to make informed trading decisions on potential entries and exits, as well as how they are going to manage their risks appropriately. Thank you for watching the video. Let us interact again in our next video.